Imagine this. You pull up a chart. Clean, precise, candles lining up like soldiers. Support, resistance, a pattern you've seen 100 times. And then, one candle appears. It ignores the rules. It erases weeks of logic in seconds. Here's the uncomfortable truth most traders never say out loud. Charts don't stop working because you're wrong. They stop working because something else just took control. And today, that something else is everywhere. Right now matters because markets feel unusually cruel. Patterns form perfectly and then fail violently. Retail traders blame manipulation. Professionals blame volatility. But the real reason sits deeper than both. To understand it, we need to talk about why charts work at all. Charts are not magic. They're memory. Every line on a chart is a scar from a past decision. Someone bought, someone sold, someone panicked, and those decisions cluster. Humans are predictable under pressure. We buy breakouts. We sell fear. We anchor to round numbers. That's why support and resistance exist, not because of geometry, because of psychology. When price returns to a level where pain happened before, people react. They remember, they hesitate, they act. Charts work because crowds repeat themselves. For decades, that was enough. In the 1970s, charts were mostly humans reacting to humans. In the 90s, faster humans. Early 2000s, humans with screens and leverage. Patterns had time to breathe. Breakouts developed slowly. False moves took days. Then something changed. Quietly, line by line of code. Algorithms entered the market. At first, they followed the same rules humans did. Moving averages, momentum, breakouts. They were faster, not smarter. So charts still worked, sometimes even better. But speed has a side effect. It compresses time. What used to take days now happens in minutes. What took minutes happens in seconds. Patterns still form. They just die faster. And then came the second shift. Not faster execution, different incentives. Modern market algorithms don't need to be right. They need to trigger reactions. Here's the hidden mechanism most people miss. Charts are built on visible data, but markets now move on invisible intent. When a large institution wants to enter a position, it can't just buy. That would push price against itself. So it waits. It watches where retail traders place stops, where breakout orders cluster, where fear lives. Then it pushes price just enough. Stops trigger. Liquidity appears. The institution enters quietly. Price reverses. From your screen, it looks like the chart failed. In reality, the chart worked perfectly for someone else. This is where irony creeps in. The more popular a pattern becomes, the less reliable it is. Not because it's wrong, because it's crowded. A breakout with no one watching is powerful. A breakout everyone watching is fragile. Charts don't break randomly. They break when attention peaks. And attention today is measurable. Social media sentiment, retail positioning data, options flow. Markets now know what traders expect before price moves. Which brings us to the uncomfortable math. Volatility is no longer a side effect, it's a product. Options markets thrive on movement. High implied volatility sells fear. Low volatility sells complacency. When volatility is mispriced, price action becomes violent to correct it. That means charts can look clean right until they need to destroy expectations. You see a perfect setup. Risk-reward looks obvious. That's often the moment it's most dangerous. Because the market doesn't reward obviousness, it taxes it. This is where hype and reality diverge. Hype says charts stopped working because markets are manipulated. Reality says charts are still working, just not for prediction. Charts were never crystal balls. They were probability maps. But probabilities change when participants change. A pattern that worked 60% of the time in a slow market might work 40% of the time in a fast one. Same chart, different ecosystem. The mistake isn't using charts, it's trusting them in isolation. Here's the quiet humor in all of this. The more indicators people add, the more confident they feel, the less they understand what's actually happening. 5 indicators agreeing doesn't mean higher accuracy. It means 5 lagging opinions echoing the same past. Charts describe where price has been. Markets move based on where liquidity needs to be. This shift changes everything. Risk management matters more than entries. Context matters more than patterns. Timing matters more than precision. And the stakes keep rising. Retail participation is higher than ever. Leverage is accessible. Information moves instantly, which means failures are sharper, losses feel personal, and trust in the system erodes faster. When charts fail suddenly, people don't just lose money, they lose belief. Belief that effort equals reward. Belief that learning leads to control. But markets were never about control. They were about adaptation. Zoom out far enough and the picture changes. Charts still work in quiet markets. They still work when expectations are split. They still work when liquidity isn't obvious. They fail when certainty peaks, when narratives harden, when everyone leans the same way. The question isn't, do charts work anymore? The real question is more uncomfortable. In a market that learns faster than you do, how do you stay useful? Because charts aren't broken. They're just no longer forgiving. And the next time a perfect setup forms on your screen, ask yourself something before you click buy or sell. Is this pattern early, or is it already famous?